this is something. 272,000.
Nancy Lazar was right. She was right.
She was right.
272,000. Everybody, the estimate was 185,000. And by the way, that blows even the top of the range from economists going in. The range was 120 to 258, and we came in at 272. The unemployment rate hit 4%. The estimate was 3.9%. So this is something else. All right, government jobs. Well, here you go, 43,000. The government jobs number was 43K. Last month, it was only 8,000. We don't get an estimate for that number, just to let everybody know here. Okay, let me go through some of the other pieces of this. Labor force participation, that rate 62.5. That's a little weaker than last month. And then, again, that rate 4%. Factory jobs, 8,000. Private sector, 229. And that's higher than expected. So the private sector number was 229K. We were only looking for 170K. All right, let me get into the earnings, because that's the inflation story I was kind of wanted to hit this a little bit. That came in pretty much in line. Average hourly earnings, the estimate was a gain of 0.3%. We came in at 0.4%. And then year over year, 4.1%. Which is a little bit hotter than expected. So again, these are wild numbers, by the way, everybody. And we'll see about these revisions, which I'm still waiting on. As soon as I get them, I am going to jump in for the revisions. But let me get into the report and tell you where. I mean, look, a lot of it, as Joni was just saying, a lot of it is the government job story. That's obviously the biggest piece of this. But let me dig into the report. Okay, basically, this report led by healthcare, government jobs, leisure and hospitality, professional, scientific, and technical services. But again, that's what the government is saying, and that's exactly what Joni was saying as we went into this, Maria. Okay. So the revisions are key. I'm going to dig into this right now.
We'll get back to you on the revisions, Cheryl. I know you're watching that. Markets are down across the board on a much stronger than expected jobs number. As I mentioned before we went into this, Piper Sandler is telling clients that their indicators are, and this is their AI is saying 218,000. We come in at 272,000 jobs, and immediately markets sell off. Vance Ginn, jump in here. We haven't heard from you. I want to get your take on this report.
Well, it's definitely better than expected, as you've already mentioned. And some of the key things that I've been looking at have been part-time jobs, which were essentially flat for what I can see so far in the report. When you look at government jobs, which has been growing too quickly, and unproductive government jobs, taking from the private sector, those up 42,000. I mean, you're really looking at about 230,000 private sector jobs. And you look at average weekly earnings, which also have not been able to keep up with inflation for over the last few years. We're continuing to see somewhat flat there. One thing that I did want to point out was that the revisions were 15,000 lower over the last 2 months. So we continue to see revisions lower. So take this one with a little bit of a grain of salt. At the same time, with what the Fed's doing, the Fed's balance sheet's still too large. And so we've still got a lot of things that are propped up across the economy. And so this is a better than expected report. But also look at labor force participation rate. It went down to 62.5%. So it's another thing to look at.
Can I give you the revisions, Maria?
Go ahead,
real quick, because I've got them. All right. So March was revised down by 5,000. That went from 315 down to 310. April was also revised down by 10,000, from 175,000 down to 165,000. So we did get those revisions for those 2 months.
Chris McMahon, what's your takeaway?
Unfortunately, I think AI's taken over the world, Maria. We can't.
Nancy Lazar did. She said it. She was her machine learning. Her machine learning told her it was going to be well above the estimate of 185.
The narrative's been a bad report. Interest rate cut. And money comes back. That tidal wave of money comes pouring back in. Our investors are saying to us all day long, when can I shed my bonds and go back into equities? That's the optimism that drives the market. And this slows that narrative down, certainly. And I think it's, they had to thread the needle, and they hit it out of the park instead, which is good for the economy, but bad short term for the market, I think.
You're talking about FOMO, aren't you, Chris? Fear of missing out.
I can't miss out. I got to get in.
It's you. I want to hear your take, Stephanie Pomboy. What do you know? What's your takeaway here, Stephanie?
Well, first, I would congratulate AI for figuring out the BS that comes out of the BLS statistical factory.
Absolutely.
They modeled that perfectly. Oh, my God. But here's the point. Household employment declined 408,000 in this report.
Wow.
The labor force also declined 250,000. That gives you the 4% print on the unemployment rate. This is the story, Maria. It's a tale of two cities here in terms of these employment numbers, whether you're looking at payrolls or households. And historically, the household survey has been a much more reliable measure at turning points in the economy, because what gets the payroll number off track is this birth-death imputation that they make for new business formations that tends to miss turns in the economy because it's based on last year's business formation data, not anything current. So I would focus on this, the household survey, which shows substantial weakness on the employment front, again, down 408,000 in the month. And I think that's really the story. And I would go on to point out that the unemployment rate has now increased 0.6 percentage points. It sounds like nothing, from 3.4 to 4.0, still very low. But historically, when you rise half a percentage point, you then go on to rise 3 full percentage points from there. So not to get too deep in the weeds, but that means we're looking at a 7% unemployment rate before all is said and done here.
Well, you know what number I don't like, Charles, is this wages. The wages, average hourly earnings, up 4.1%. That points to inflation, Charles. A couple of days before we get the CPI on Wednesday. Your takeaway?
No, you're absolutely right. And I think some of the composition, less retail jobs, less lower paying jobs, speaks to that. But I tell you, it's, when I was saying before, we were poised to go up a lot more than we went down. I mean, think about this. So far, the move to the downside has been somewhat mitigated, if you think about how big of a beat this is. And that's because, to Stephanie's point, 250,000 people left the labor force. I mean, really, if you just say how great is the labor force, there's so many jobs out there and they're paying so much money. Why would 250,000 people leave the labor force? That is mind-boggling. The unemployment rate has gone up for almost every group. Also, 27 weeks or longer, long-term unemployed grew. And it's up month over month, year over year. So there feels like there may be a group of folks who, if you haven't gotten a job, just like in the initial jobless claims, yesterday, those longer-term jobless claims are starting to grow. We're getting closer to 2 million. That's a worrisome. Also, employment to population ratio. This is one of my favorite gauges because it adjusts for our population. That's actually down month over month and year over year. So, there's still parts of this that points to an economy where a bifurcated economy, if you will, and I think maybe to a degree that mitigates how much we go down. Again, we were poised to take off if the numbers were, allowed the Fed back in the game. This does not allow the Fed back in the game, hence the initial reaction.
Well, and what about the Stephanie's point of the households? Households down 408,000?
I'm glad you brought that up. Did you see, so Bloomberg did a piece, an amazing piece. They have a woman over there, Anna Wong, who's just fantastic. And according to their work, last year, the jobs were overstated by 730,000. 730,000.
Oh, my God.
In fact, they say October may have been a negative number last year. If you're going to be honest about this, unfortunately, by the time the true revisions come in, they never make the headlines.
Yeah, it's a great point. Then, Cheryl, I'd go back to you with all those revisions. I mean, are we going to see a big, significant revision to this? 272,000 jobs? Well, we'll see a revision next week or next month.
I don't know, Maria. Maybe somebody could ask AI, the whole thing, because apparently the AI is the one that predicted everything. But, this trend of these revisions has been happening since the month of January. Look, March and April, those revisions weren't as substantial as we saw at the beginning of the year. But I will say that I have a sneaky suspicion that next month you are going to get some revisions to this number. The one thing I was a little surprised about was we didn't see a real big jump in leisure and hospitality. I mean, 42,000, that should have been a little stronger because of the summer season. And then the other thing, and Maria, you were talking about this earlier, and I'm so glad you brought this up, is part of the situation with immigrant workers. Look, if somebody's out there working with a stolen Social Security number, they're getting counted. And so that's something else that can distort these numbers. Now, that's a legal issue that I'm sure the Labor Department's not going to get into, but I think it's something that has to be kind of factored into all of this.
Yeah, so Vance, how do you factor it in? I mean, you're the former chief economist at the OMB, and when you look at the overall picture of the macro story, what kind of allowances do you have to put in there knowing, oh, we're going to get a revision here, and oh, yes, the headline says this, but it's a lot of part-time and it's a lot of non-citizens?
I mean, you have to take each report with a grain of salt to a certain extent. I remember when I was there from June 2019 to May of 2020 in the White House, we were constantly revising it up until COVID hit and everything else. Now we're revising it down. It's been this way for over a year or more. So a lot of that has to do with their seasonal adjustments and the way that they do these things. They're using data from the 2021 period during COVID and everything. And so that throws a lot of wrenches to this. But I also think that there's underlying weakness to this. I mean, when you continue to talk to Americans, they say that this is a weak economy. Many people feel like we're in a recession. And a lot of that goes back to inflation and wages not keeping up. I mean, since Biden took office in January 2021, average weekly earnings are down 4.4% adjusted for inflation. That's not a good situation for Americans.
And wages are down as inflation goes up, right? Prices are up. They're eating into wages. That's why we see the polls the way that we do. Chris McMahon, you've got to tell clients something at this point, wealth advisor. What do you want to tell clients about how they should be reading this report and what this means for allocating capital for the rest of the year and into next year?
That's the question of the day. I mean, we've been telling people forever, right? Buy the dip, buy the dip. That's what we say over and over and over again. We're saying, consider now a little bit more cash. Certainly there's not going to be a Fed rate cutting soon, so you're going to be paid for that cash. So we're saying, the term sell the rip. You bought you had some AI stocks go crazy. You have some great gains. Sell those things. Take some money, keep some powder dry, and maybe make that allocation, Maria, that 60-40 or 70-30 allocation. Take 6, 7, 8, 9% more out of equities, put it in fixed income, and just take a breath. And let's get ready for the election period. I think that's a good way to go.